And for a look at what lies ahead for bonds, let's bring in Bill Campbell. He co-manages DoubleLine's Global Bond Fund with Jeffrey Gundlach. Bill, it's good to see you. Welcome to Halftime.
Thank you for having me.
It's a stunning move that we've seen this week. So what do you make of it, and how low do we go?
Well, it's an interesting phenomenon that we've seen, this rally from 325 at the end of last year to 187 today. I think you need to look at the move in its totality. When we look at the futures market, the futures are pricing in 50 basis points of further cuts this year and 75 basis points of cuts through the next 12 months. We think that a lot has been priced in. The house view at DoubleLine is currently neutral, but in the near term, given this momentum, I could see, especially following the trade, the potential implementation of tariffs in the trade dispute, you could see the 10-year trade down to 175, 170, and then consolidate. What we're looking at going forward is data either to continue to materialize to the downside, or we're against what we have been talking about more on a medium-term basis is increased Treasury supply. A budget deal is just passed. It's $1.37 trillion. It looks like the president is going to sign that into law. So we think that these countervailing forces, the market is probably going to need to sort out in the coming weeks to months between what is the future prospect for economic data versus the large amount of supply coming on.
How many times does the Fed go from here on out, do you think?
I really think that depends on, as you were talking about earlier, does President Trump actually implement the tariffs on September 1st? If he does, I think that the market pricing is probably fair. If he doesn't, or he delays it, maybe we only go another 25 to 50. I think that when we look at the tariffs, one thing I wanted to point out is this new 10% tariff is on consumer goods mostly. The prior tariffs really didn't affect the consumer. When we look at the Q2 GDP report, it was all carried by private consumption. And now this tariff is specifically going to target the consumer. More concerning and Jerome Powell pointed this out, on the CapEx side, on the capital spending, we've seen some material weakening. I know Eddie Lazier pointed out that a lot of that was due to the inventory adjustment, but one thing that caught my eye was the fact that IP spending and equipment spending, which had been running fairly hot following the Trump tax cuts, has now come to basically flat. And that, the equipment spending and IP spending, tends to be the precursor to future productivity growth. So I see some headwinds, that are building for the economy, specifically on both the CapEx side, but President Trump's new tariff could hurt the last engine of growth that we're currently seeing, which is private consumption.
Mm-hmm. Hey, Bill, I think that's a good point. This is Josh Brown, by the way. So isn't it also true, however, that our economy, probably unique versus every other economy in the world, has so many offsets and so much of a seesaw makeup that, for example, we say, okay, this next round of tariffs is going to be bad for global growth and arguably could hurt consumer demand via higher prices. Okay, that's fine. But now lowering rates possibly gives maybe a little bit of a lift to borrowing to buy a home. Or maybe the drop that we saw in oil and eventually gasoline this week, maybe that helps the consumer at the pump. So it's very hard, in my opinion, to just say, okay, here's one event that happened and there's a black and white result. I think there's enough give and take where these tariffs, while they are now targeted towards something new, there are some benefits that come along with what Powell has had to do as a result of that maybe offsets it, and it's a push. What are your, oh, by the way, and wage inflation may be slowing too, which helps corporate earnings. So, like, what are your thoughts on that whole stew of different ingredients?
Well, you've pointed out a lot of cross currents that we're currently monitoring. On the wage side, wage inflation, or average hourly earnings, remaining above 3%, is positive for the consumer on one side, but remember that's going to eat into corporate profits on the other side. Jerome Powell, I think, when I look at his messaging and I look at the Fed's messaging in totality, it's been very confusing. leading up to the blackout period for this meeting, we heard a lot of discussion about low inflation, and that's a global discussion, actually. We heard discussion that with interest rates so low and so close to the lower bound that you may need to act more forcefully initially to try to stimulate economic growth. And then we got to the press conference, the cut at 25, I think. The market initially said, okay, maybe we'll do 25 this time and 25 for the next meeting. But Jerome Powell seemed to not really open the door wide open for that next 25 basis point cut. So although I do agree with you that offsets of large Fed cuts can help to a certain extent offset some of the trade impact of tariffs, I question the Fed's commitment to actually delivering on those cuts that are needed. And I think that that's going to keep investors kind of half invested. I think investors still, remain invested in what they, are comfortable with their core thesis, but they're really not, overextending themselves on risk right now.
Bill, we appreciate your time helping us figure out where we are and where we may go from here based on this week's turbulent events. That's Bill Campbell, DoubleLine.